Today, we're going to pull back the curtain on a world of financial mystery, shell companies. We're going to look at exactly how they're used to move millions of pounds out of the UK, and maybe more importantly, what the government is doing to fight back. Let's dive right in.
Now, this whole breakdown comes to you from the experts over at Pro Tax Accountant. They've given us the key insights from the front lines of UK tax law, and that's exactly what we'll be exploring today.
So, let's kick off with a bit of a puzzle. How on earth can a company be making millions of pounds on the streets of London, doing all its business right here, yet its legal home is, well, it's nothing more than a name on a filing cabinet in the sunny Caribbean? It sounds a bit like fiction, right? But it's a reality we're about to unpack.
Here's our game plan. We'll start with that puzzle. Then we'll define some really crucial terms. After that, we're going to open up the tax avoidance playbook to see how it all works. Then we'll look at HMRC's big counterattack, the global push to unmask the real owners, and finally, the crackdown that's happening as we speak.
Okay, first up, the shell company puzzle. Think of this as a bit of a financial detective story. We're about to find our first and most important clue.
So, what is a shell company really? Well, at its heart, it's a company that pretty much only exists on paper. It has no real substance. It doesn't make anything, it doesn't sell anything, it often has no employees or even a real office. Honestly, the best way to think of it is like a legal P.O. box for millions of pounds. It's just a registered address, usually in a low-tax country, designed purely to hold assets or channel money through. The shell is totally empty of any real business, but as a tool, it's incredibly powerful for moving money across borders.
Right, before we go any further, we need to draw a really important line in the sand. We've got to talk about the huge difference between tax avoidance and tax evasion. The line can seem a little bit blurry sometimes, but trust me, the legal consequences are worlds apart.
So, on one hand, you have tax avoidance, which is technically legal. It's all about using the tax rules exactly as they're written to find loopholes and lower your tax bill. But, and this is a really big but, HMRC can and absolutely will challenge any arrangements it thinks are artificial or abusive. They'll say it goes against the spirit of the law. On the other side of that line is tax evasion, and that is straight up illegal. It's deliberately breaking the law by hiding income, lying about your finances, the whole shebang.
And the penalties? Well, they show just how different these two things are. For offshore tax evasion, the penalty can be a mind-boggling 200% of the tax you tried to dodge. That's on top of paying the original tax bill plus interest. And that's not even counting the very real risk of going to prison. This number alone tells you everything you need to know about how seriously the authorities take crossing that line from bending the rules to breaking them.
So how does this all actually work in practice? Let's open up the tax avoidance playbook and look at the exact strategies people use to exploit these shell companies.
To make this all feel a bit more real, let's picture a small but really successful creative agency. They're based in Soho, London, doing fantastic work, landing big clients, and making some pretty healthy profits right here in the UK. But now they're facing a pretty hefty corporation tax bill, and they start looking for, well, creative ways to reduce it.
The playbook basically has two main moves. First, you try to shift the company's official tax home, its residency, to make it look like it's being run from a low-tax country. And second, and this is the really key part, you shift the profits you actually earned in the UK over to that offshore location, where, surprise, surprise, they'll be taxed at a much lower rate, if at all. So let's see how they try to pull this off.
And here's a little pro tip for you on that first step. Shifting a company's residency isn't as simple as, say, flying to Bermuda for a board meeting once a year. See, HMRC has this really solid test called central management and control. And they don't care where you hold a meeting to rubber stamp decisions. They want to know where the real strategic thinking happens, the stuff that actually drives the business. Approving major deals, setting the company's direction. If that's all still happening in a London office, then as far as HMRC is concerned, that company is still based in the UK. Simple as that.
Okay, so if moving the whole company is really tricky, how do they get the profits offshore? Well, this is where it gets clever. Our London agency goes and sets up a shell company in a place with zero corporation tax. Then, this new shell company is made the legal owner of the agency's most valuable stuff, its brand name, its client list, its special software, all its intellectual property. The London office then pays massive licensing fees to its own offshore shell company just for the right to use its own brand. The result? The profits on paper in the UK are wiped out, and all that cash is legally sitting in a tax-free haven. Stay with me, the next point might surprise you.
So that's how millions of pounds in profit can just vanish offshore. But this isn't a one-sided game. Now let's look at how HMRC and the UK government are fighting back.
And they've got some seriously powerful tools in their belt. The number one weapon in HMRC's arsenal is this: the General Anti-Abuse Rule, or, as everyone calls it, the JAR. It was designed specifically to shut down tax arrangements that, even if they technically follow the letter of the law, are just fundamentally artificial and go against what Parliament actually intended.
The real power of the GAR is that it doesn't get tangled up in tiny technical details. Instead, it asks one simple but incredibly powerful question: is this whole setup a reasonable course of action? Let's think back to our London agency paying its own shell company millions in fees. The GAR would look at that and ask, would any sensible business do this if it wasn't for the tax benefit? Of course not. It targets these totally contrived steps that have no real economic purpose beyond slashing a tax bill, and it can just ignore them and make you pay the tax as if the scheme never even existed.
You see, a huge part of this whole problem has always been anonymity. For years, these complicated structures worked because they could operate in the shadows, with the true owners hidden behind layer after layer of corporate secrecy. So a key part of the solution has been to just switch on the lights.
And the new Transparency Toolkit has three main parts. First, there's the People with Significant Control Register. This forces UK companies to publicly name their ultimate beneficial owners, the real people actually pulling the strings. Second, the Register of Overseas Entities does the same for foreign companies that own UK property, which closes a massive loophole. And finally, there's this growing web of international data sharing agreements, which just means there are fewer and fewer places in the world to hide money without tax authorities finding out about it.
And please, make no mistake about this. These rules and registers aren't just sitting on a shelf collecting dust anymore. They are being used, and the crackdown is very, very real. For anyone involved in these kinds of schemes, the entire landscape has changed.
Just look at how quickly this has ramped up. Back in September 2017, new laws made it a corporate crime to fail to stop someone from facilitating tax evasion, but for years, not much seemed to happen. Then, fast forward to January of this year, 2025, suddenly HMRC confirms it has 11 active investigations running. And then, in August, the first big domino fell. An accountancy firm, Bennett Verby, was officially charged under those very laws. This is a landmark moment. It shows that the authorities are now actively prosecuting not just the people dodging tax, but the professionals who helped them do it. The game really has changed.
Okay, so before we wrap up, it's really important for me to say that the information we've gone through today is for general guidance and educational purposes. It shouldn't be seen as formal financial advice, and you definitely shouldn't rely on it alone when making financial decisions.
Look, tax law is incredibly complex, and as we've just seen, it is constantly changing. For expert advice that's actually tailored to your personal situation, it is absolutely vital to talk to a qualified professional. If you need guidance on any of this stuff, you can get in touch with the experts at ProTax Accountant using the details right here on the screen. The big takeaway from all this is simple. The shadows where these complex schemes used to hide are disappearing fast, and the risks for anyone using them have never been higher. Thanks for joining me.